thank you so much for joining us today, Ben, for our ESG Investment Influencers series. I'd like to start by asking you, what's really driven your passion for sustainable and ESG investing throughout your career?
Sure. Well, I think it really started when I was at university and I studied politics, and during that course I took a few units that were focused on sustainable development, which kind of triggered a bit of an interest at that stage. And then building a career in wealth management, it was always an area that I wanted to drive my career towards. And then I've had that opportunity at Brooks Macdonald over the last 3 to 4 years, helping develop the responsible investment service that we now have, which has been great for me personally, but also I think good for us as a business.
And we've seen this real transition, I mean, especially over the last year or two, as the whole industry really gets behind sustainable investing and it moves very much mainstream. What do you see as the big opportunities there for investors?
I think there's a few areas really. If you're looking at it thematically, then I think one of the big trends that certainly came through last year was this commitment from a number of global governments to transitioning their economies to net zero carbon emissions. So we're at a point now where over 50% of global GDP is governed by those types of commitments. So from an investment perspective, we think there are going to be long-term structural tailwinds behind areas that are focused on transitioning those economies, whether that's cleaner energy or the transition of our transportation networks to become electrified. Also on the other side of the same coin, if you like, around opportunities to become more efficient about how we use energy. And then secondly, looking at some of those social areas. Again, if we use 2020 as a case study, then something that certainly came to the fore was the requirement for strong health and hygiene standards, not just within healthcare systems, but across the economy. And then finally, if we're looking at the internal management of businesses, something that the spotlight was shone on was how businesses managed their human capital, whether that be their employees or also through their supply chains. And I think companies that can consistently demonstrate that they're able to effectively manage those areas of those businesses will prosper long term.
And just in terms of your own sustainable offering there for clients, maybe you can just give us a little bit of an overview about how you've addressed that at Brooks Macdonald.
Absolutely. So we have what we call the Responsible Investment Service at Brooks Macdonald. And within that, we have 2 strategies that clients can pick between. The first we call Advance, and that strategy is focused very much on the positive inclusionary reasons for investing in businesses. And we really define it in 2 ways. We're looking to invest in solution providers. So through the products and the services of those companies, there's a clear alignment to addressing a sustainability challenge. And then secondly, we're looking at responsible businesses. So we define those as companies that have really taken ownership of those environmental and social impacts and have already made good strides in reducing or mitigating the negative impacts and improving the positive impacts, and have roadmaps in place to continue on that journey. The second strategy that we manage for clients, we call Avoid. And that is very much based around negative exclusions. And for us, we identify those as armaments, tobacco, alcohols, gambling, and adult entertainment. So in that strategy, for a fund to be suitable, they have to have hard exclusions in those areas.
What messages are you getting from clients on sustainable investing, and how are you trying to meet those needs?
Sure, I think there's probably 3 key areas that we consistently come across with clients. Firstly, it's confusing. Trying to integrate some of those personal values into investment portfolios can still be a confusing conversation for clients to have. So we're looking to try and do a lot of work with clients and their financial advisors about simplifying that confusing landscape in terms of terminology and the range of approaches, which is one of the reasons why we've come up with that streamlined service of 2 strategies that we can build portfolios around. The second area is how can you actually demonstrate that you are actually aligning those portfolios with those mandates. So again, this comes down a lot to communication, but also reporting. And this is an area we've looked to develop over the last 12 months about how can we report to clients about how their portfolios are truly, in the case of Advance, addressing those sustainability challenges, or in the case of avoiding those 5 underlying areas. And then thirdly, it's more of a general point, I think, around just how can clients look at a slightly broader view of sustainability. I think sometimes the conversations start out with singular issues, but actually then the conversation broadens into it's a very wide landscape, sustainability, and how can we integrate multiple areas of those within a portfolio, and what are the potential benefits of that for achieving financial objectives.
And just looking at sort of the main elements of your due diligence process when you're selecting funds for the portfolios, what's really important for you then?
Yeah, we try to build a very structured approach to how we do research in this space. And this is another reason why we've come up with streamlined solutions, so that we can build structure around what we're looking for. And for us, there's 4 key stages. Firstly, it's identifying what the opportunity set is. As you've already identified, it's a very fast growing space, and there's new strategies being launched every single month. So it's about understanding what that growing opportunity set consists of. The second stage is around the analysis. So really understanding out of that opportunity set, which ones best align with our 2 strategies, but also offer the best, in our opinion, risk-adjusted returns moving forwards. And within that analysis stage, we do use some quantitative analysis, looking at ESG data. For us, we use Morningstar, which in turn uses Sustainalytics. And it also has a very strong leaning to qualitative assessments, which we structure around a questionnaire format. For us, it's important that the quantitative data informs the qualitative process. It's not a screen in itself, and maybe a conversation for another day, but there's lots of nuances around the data, or I should say lots of nuance that can get lost in the data. So we use it to inform our qualitative processes. And from the qualitative side, we look at the fund house. So for us, for our clients, we believe we're investing at 2 levels: in the underlying companies they're exposed to, but also the fund management group that run that strategy. So we look at the fund management group, and then the processes within that particular fund, and then a review stage looking at the outputs of that fund. So what we do then is bring all those quantitative and qualitative areas back to fund manager meetings. It's always important for us to meet the managers, and then we can go through any areas of contention that we want to assess with them. And then ultimately, if deemed appropriate for either avoid or advance, it will make it onto our central buy list.
And just in terms of the challenges when you're assessing funds in this area, where would you like to see fund providers give more information to help in your decision making? What are the big sort of challenges here?
I mean, the big challenges really are around the breadth of approaches, and this is a challenge, but I don't think it's a challenge that should go away. Having a range of opportunities and approaches is a good thing. It's just trying to understand how best you could compare apples with apples. But I do think that you need to engage with those nuances around different strategies, and quantifying it through these ESG data sets can be helpful as an input, but it will never drive out some of those subjective challenges and decisions that you've got to make as a fund selector. In terms of what fund houses can do, I actually think they've done a lot of very good work over the last couple of years about communicating to fund selectors and end clients what their process entails, and then actually the outputs of their fund in terms of sustainability or impact reporting. So I think they've done a huge amount of good work. Where they can improve, I think, will ultimately depend on the quality of the company level data that they invest in. And I think that's where the primary drivers of improvement need to come, in terms of the consistency of the underlying company data, which will ultimately allow the improvements in fund level reporting.
And just in terms of funds in the portfolio, can you highlight a couple of names there that you've either sort of added recently or you think are particularly interesting?
Yes, I suppose a fund that we've added recently within our portfolios would be the 91 Global Environment Fund. And this ties back into one of your previous questions about key themes within portfolios. And this strategy takes a very focused approach to investing in the decarbonisation of the global economy within 3 areas that I've already mentioned, actually: cleaner energy, resource efficiency, and electrification of transport systems. And we think the team there are extremely strong, with very strong processes behind them, because ultimately within those themes, there will be winners and losers. So you want to make sure that you're trying to align yourself with teams that can identify the long-term winners. And then the second fund that I'd highlight, which is very different, in a real asset space is an investment called Home REIT, which is a real estate investment trust, which launched last year. It's a really interesting investment story because what it's trying to do is build a portfolio of properties to rehome homeless communities. And there's a very strong investment case behind it because there's a huge mismatch in terms of demand and supply. So we think that it meets a real social need, but also has those strong investment drivers. And the third element to it is that it's got a partnership with Crisis, the charity. We think that's a really interesting investment model, partnering with a charity, because that can add validity to the investment strategy with that independent oversight, which I think is going to be of growing importance in this space.
And where are the product gaps for you going forwards? Where would you like to see a greater range?
Again, I'd start off by saying I think the investment industry has expanded significantly over the last couple of years. I think if we go back certainly 5-10 years ago, then it was really about investing in equity strategies. That's where the predominance of opportunity was. But certainly when we look across some of the other asset classes, particularly in fixed interest, there's been huge development with regards to the assessment of ESG credentials within fixed income, and then specific structures within that, things like social bonds, green bonds, impact bonds. In the real asset space, I've already mentioned a specific investment there, but if I take a step back, then there has been a big growth around areas like investing in clean energy infrastructure. We've seen a number of fund launches last year around that resource and energy efficiency theme. And then some of those social areas like the healthcare property trusts, and as I mentioned, the homeless property trusts. So I think the universe is expanding. If we try to compare, I suppose, an asset allocation of a standard core portfolio and a responsible investment portfolio, then there are areas of difference. And the main ones maybe be around those alternative allocations, the traditional long-short strategies, and whether they actually do align with these types of solutions. There's been a few attempts in that space that we've seen, but nothing to date that has really met our requirements. So it'll be interesting to see if that piece of the investment industry can really get their heads around how can you truly integrate sustainability to a sufficient level.
Yes, and just sort of following on from that, so in terms of looking ahead, what would you now like to see from the industry as it evolves in this area? What are key things you're looking out for?
I think really it's a case of seeing the current trajectory in terms of innovation, in terms of product development, in terms of just conversations and the macro setting for sustainable investing. But also, I think a big theme over the next couple of years will be the regulatory backdrop. We're seeing things in Europe this year being introduced, which we would expect to be mapped across in some guise into the UK over the next couple of years. And I think that will inform a lot of the developments over the next couple of years around trying to produce greater clarity for fund selectors, but ultimately, importantly, for end clients, which I think will be a good thing, but there will be challenges to that about driving out some of that nuance, which I think is very important for us to engage with. So I think if I look at the next couple of years, the big trend will be trying to meet the changing regulatory environment, whilst also communicating in a very clear but honest and open way with end investors as well.
Thanks very much for that, Ben. Thanks very much for your time today. We covered a lot of areas in a very short space of time. It's great to chat to you, and we hope to catch up again very soon. Thank you.
Thanks very much, Kat.